All right. Sorry, we're a minute late. Things have been crazy. Michael was at the New York Stock Exchange. By the way, can I get some hands up for how good Michael looks today?
Oh, thank you.
Michael's having a glow up now. This is going to be a new thing for him, I'm told.
Look how glowy my lips are.
Yeah, tailored. Bang. All right.
You know what season
Big
it is?
day.
It's Vaseline on the lip season.
My guy,
It's almost
Valentine's Day. That's what you have going on. You putting the vibe out?
I don't know what that means, and I don't want to find out.
Putting the vibe out?
I don't want to find out what that means, but let's keep it moving.
All right. Very big day today. Very big week this week. Arguably the only week that matters in terms of earnings season, which we're going to get into. We have so much to do. But I want to, before we even do the sponsor, just a quick earnings check because it's that time of year, and we had some big names report seconds ago. It looks like they're all negative other than Starbucks. So Microsoft down, Alphabet down, AMD down. Nothing crazy. Microsoft had a double beat, but the stock went up a lot. AMD, there's some questions about the guidance wasn't bullish enough. And Alphabet, like flat out, had a disappointing revenue number. So that's right. Am I missing anything major? Not yet,
and
right?
the reactions seems very normal. Nothing alarming.
Nothing
at
crazy.
all.
And Starbucks. Get a quick eyeball on that. Is that still higher? Is that green?
Oh wow.
Yeah, this thing's beasting, bro.
I thought Starbucks was being weird. I thought China was going to zero. I thought Starbucks was a China.
Well, what do you know? All right, let's do the sponsor, Y Charts. Tell us about it.
On the Compound and Friends, remember Neil Dutta? He saw my Y Chart sticker. He goes, "You guys like Y Charts?"
Yeah.
Do we like Y
Yeah,
Charts?
that wasn't scripted at all. He was genuinely curious.
You know, a couple of months ago, I was talking about, actually just a month ago, one of my New Year's resolutions was to see how much time I spend on my phone. Like, I want that to go down.
I'm guessing 6 hours a day. Are you 6 hours a day?
This week it's at 9 hours, but that can't be right. I genuinely don't.
Right.
It can't be really. It can't be right because I was at 4 hours a day.
No.
Anyway, I want to report like how many hours a day do I have Y charts open on my tabs? All the hours. It's always open.
Oh yeah, it's always open.
It's like a fifth appendage.
Yeah, it's the first thing that I click into when I have a question about something or I'm curious just on the fly. We wanted to bring back some survey results that Y Chart shared last year. One of the biggest findings, aside from advisors saving 29 hours on average, 26 million in new AUM surveyed advisors saw during the past year for using Y Charts. So do you have any color on where that number came from or how they figured that out?
I don't, but I'm a pro survey guy. So if the survey says it, gotta be true.
All right. 20% off your initial Y Charts Pro subscription when you start your free trial through us. What you want to do is go to go.ycharts.com/compound. Very simple. Check it out if you haven't yet. We use it all the time. You're going to see a whole ton of Y charts on the show tonight. Okay, earnings so far. I think that there's a really good case to be made that this, I know we always joke around like, oh, it's the most important earnings season ever. In this particular case, I think this one is really important because right around now, according to someone very intelligent, Yuri and Timmer at Fidelity, is historically where you need to see, all right, good to see you, is where you need to see earnings growth take the baton from multiple expansion. We've obviously had a ton of multiple expansion, especially in NASDAQ names, especially in growth names. It's not that we haven't had any growth on the bottom line, but now that should be the story, and you should not be expecting higher and higher PE multiples. Michael, do you want to set this up?
Let's set it up. All right, chart on, please, John. So this is from Urian over at Fidelity. The black line is the S&P 500. And underneath, you've got this really nifty chart that shows how much of the gain came from multiple expansion, i.e. the price to earnings ratio, versus earnings per share growth. And for much of the recent part of the cycle, which is the rise to new highs, as we've been discussing ad nauseum at this point, it's been all multiple expansion. Now, can that continue indefinitely? No. Can it continue for longer than you might think? Sure, but it would be really nice. It would be really, really nice if the next leg higher in stocks is driven by earnings growth as opposed to just people becoming more optimistic about the future or inflation coming down or whatever, what have you.
So far, this is a quote. So far, we've got 93% beating by an average of 8.24% on earnings. The growth estimate coming into earnings season is only plus 1% year over year. If history is any guide, that will improve to plus 4% or so. So as things progress, the number goes higher. Is I think the big takeaway. So none of these numbers are ever static. For calendar year 2024, the estimate is for 10.7% earnings growth. And that number will come down to a more trend-like 7% growth, but at least the starting point is high. For 2025, it's 12%. So this falls well within the typical range of what we see for earnings expectations and beat rates. And so far, like everything just seems pretty normal. What are these earnings reaction charts? Can we put these up?
Yeah, so I think at this point, I think at this point, a muted reaction to beats is not super surprising. You would have to have absolutely blowout, and more importantly, forget about the earnings. You would have to have guidance come way up for stocks to have an even bigger gain. Because again, we'll get to this later in the show. We just had a historic run in the stock market. I don't know if you know that, but we just had a historic run. So what this is showing you is, this is from Bank of America, when companies beat on both the top and the bottom line, the one day later, they are having a less strong move than historically so over the last couple of years. Again, all normal stuff. The market had a crazy reaction. So if we can go sideways this throughout the next couple of weeks, I think that'll be a win.
When you hear people say, the beats are not being rewarded this quarter.
They already were.
Well, no, forget that. Just generally, not just, I understand the market's just had a huge run up, but just generally speaking, when you hear people expound on the average S&P 500 company's reaction to an earnings beat, do you think there's any signal there other than telling you like maybe what the current environment is? Does that mean anything for the rest of earnings season necessarily? Can't that change a week later?
It can. So the fact that companies are not having a positive response to earnings beats tells you nothing because the market discounted that. We just had an incredible run. Now, if we were in a bear market and stocks were beating and still selling off, that would be alarming. In that case,
I totally agree with that. That's worse. I mean, obviously it's worse.
Yeah, that would be alarming. But this is nothing with nothing.
What if this is one of those things that works in only one direction? Meaning, what if we're in a market environment like this? You've had stocks with by the way, AMD, which reported tonight, it went up 160% last year, and then went up another 20% in January. So people are upset that it's like red in the after hours. Like what? It almost wouldn't matter what they had to say after a run like that. But so what if this only works in the opposite direction, where you have companies that are coming out and they're reporting worse than expectations, and the stocks are not going down? That to me is like one of the best. I love that setup. I mean, that's not where we are, but that's a great setup.
By the way, credit to me. Telling, not that I told you to sell AMD, but you sold it with me last week.
Put it up. Pound it out.
181.
Right.
But to the point, the reason why I sold AMD.
By the way, now I want it to go to zero. That's how my mind works. I think you know that about me.
Stop. The reason why I sold AMD was because it just kept. It was when you see a stock and it's going up at like a 45-degree angle. And then for 3 months, it just goes straight up. It felt like a blow off top, and it wasn't the short term. This thing is up 78% in the last 3 months. What do you expect it to do after? Like, seriously.
That's right. Oh yeah, Poppy. I don't do 81 RSI. That's not how I go into earnings season. I just don't do it. So, I don't do vertical stock charts into earnings.
So even if this thing went down 8% tomorrow, I would say, okay, big deal. It's up 78% in 3 months.
Hey, we have something to promote.
Yeah, we
we're
do.
trying something, guys. We're trying something new. It's going to happen on Monday, February 5th, this coming Monday, and I hope you like it. Look, the financial media. Here's how the financial media covers earnings reports. They say, "Well, the report comes out 5 seconds ago. Okay, what's your reaction?" And I understand that. It's like sports, of course. However, I think there's room to wait a few days, digest what actually not only came out in the earnings release, but then what happened on the call and what happened over the next 2 or 3 days in the markets and what did analysts say. I think that life cycle, which typically is like 2 to 5 days, that's the better story and nobody does it. The TV, they move on. I get it. No disrespect. Twitter, forget about it if it didn't happen 5 seconds ago. We're going to try something. We're going to bring on really smart people and dissect the biggest week of earnings each quarter. So if it goes well on Monday and you guys tune in and you share it with your friends and the comments are popping off, we'll do it again. But it's called Great Quarter, guys, and it premieres on Monday, February 5th. I don't know the exact time we're going to throw it up, but I hope you like it. We're going to get into all of these reports in much more detail. Am I selling this right?
Detail.
Yes.
Detail. What in the world?
What
in the finances got it into you?
It's actually finance.
So for the first show, we're going to be covering Google, Microsoft, Meta, Apple, and Amazon. And to Josh's point, like there is room for sober analysis after the fact. Forget about what the market.
Sober.
Forget about what the market did in the after hours. So Monday morning, we're going to drop it on YouTube before the market opens at like 7:00, and it'll be on TCAF Tuesdays for the next week. So I'm really excited about it.
I'll be on cough syrup. If you're subscribed to the channel, you will get the alert. So for those of you watching that haven't subscribed yet, do yourself a favor. All right, let's keep moving. What do you got?
Let's talk about Tesla. So Tesla, the stock is in trouble. You could say that the business might be in trouble as well. Let's throw some charts on.
I've heard that before, though, Michael.
Yes, you have. Yes, you have. So Tesla is now.
Hold time out. This isn't a bear market for 2 full years. I don't think that's appreciated enough. This stock peaked in Q4 21. It is the only of the Mag 7 not within 10% of an all-time high. Do I have that right?
Sounds about right. Did you know?
I don't think this looks very magnificent.
Did you know that Tesla, relative to the S&P, that chart peaked at the end of 2021, and in fact, so was Tesla up? Was Tesla up 1,000% in 2020?
Yeah, it's the year.
Now,
and then they had to get added to the S&P 500. It was up so much that the committee couldn't ignore it anymore. Like they had to add it.
All of the outperformance since then has been taken back. John, chart on please, the next one. So this is showing you it's in a 53% drawdown. The market cap peaked at 1.2 trillion, which is unbelievable. It's now at 600 or so billion. But the next chart, please.
Wait, how many dollars in market cap did Tesla lose? I'm sorry, go back.
600.
Do you know how much money that is? Like in USD?
Do. It's 600 billion. It's 600 with a lot of zeros.
Oh my God, that's so much money. That's bigger than most publicly traded companies that have ever existed. Obviously.
Next chart. Yeah. So this is Tesla divided by the S&P. And
Gross.
you see 2020 was just, totally absurd. And
they put this thing into the S&P just in time for it to be a net detractor.
Big deal.
Can we go to the comments really quickly, because there's some insight here. First of all, this hit the tape right before we started the show. Elon's $55 million pay package was just invalidated by a judge. Now, I'm pretty sure that'll be appealed, and he doesn't believe in judges and whatever, but he's not accustomed to not getting his way. The board would never take away a pay package from him. This only could come from a suit or a court. That's one. Two, Tesla is struggling against BYD, which is one of the bigger EV manufacturers in the world. It's Chinese. They don't have the game on smash the way they used to, like maybe 2 years ago. Patrick is pointing out batteries are not charging in freezing weather was a big hit to Midwest sentiment toward buying a Tesla. I sort of agree with that. I feel like if somebody gets stranded because their battery won't operate and in the Midwest, it's like, I don't know, 6 months out of the year, it could be negative 10 degrees, and somebody gets stuck somewhere, how many people do they tell that story to? 100? At least 100. Okay. That kind of shit gets around fast, and that's not a Tesla-only issue, but Tesla has almost all the market share in EVs, so that kind of problem becomes synonymous with the brand. So you have a lot of negative stuff, and then last conference call was another wreck. That's 2 in a row. The takeaway, nobody was excited after the call. The takeaway was, why is this guy putting microchips in people's bodies and not like making the cars go vroom? So that's the sentiment around the stock and around him personally is pretty tough right now. So anything you could think of that could turn this around? Like robot stuff?
Well, it's not a total. No, it's not all bad. Model Y is the best selling car in the world. That's kind of wild.
Yeah.
Not the best EV, the best in the world.
You don't think it's in the stock? It trades 20x the multiple of every other automaker.
So an analyst at GLJ Research said Tesla's resulting guidance show it's nothing more than a struggling car company. Morgan Stanley put out a note about GM,
Adam Jonas.
But obviously, this is very relevant to Tesla. EV forecasts still look too high, even better than Tesla. Even better than Tesla starting the year out. Whatever. We don't have to get to the GM part of it. But
Roger Weatherford saying the Model 3, Y, and X all look the same. There's something to that. Because whenever I get an Uber these days, it's almost always, if I'm not getting a truck, it's almost always a Tesla. And I don't know the difference. I know what the S looks like because that shit is hot. I don't know what these other three. Like I couldn't tell you one from the other. Do you know the difference?
I know
is the Y the crossover.
I know the Model S is the big one.
No, that's the good one.
Duncan just got a new one. Duncan got the Y. Duncan got the Y.
Okay.
And the 3.
Well, Duncan only got that because he loves Elon's politics.
He does. I think the Model 3 is the smaller S, and the Y is like it's kind of like a van-ish. It's like van-shaped.
Yeah.
I don't want to step on too much of this because we're going to talk a lot about this on Great Quarter, guys. But I would just say generally, betting against Tesla has not really been a great strategy.
Except for the last 2.5 years it has. Before that, no. And in fact, the worse things were for Tesla, the better of a time it was to buy. In like 2018, people were pretty sure they were going to miss all these debt payments and go to zero. And that was like one of the greatest buying opportunities in history. So I totally get your point. And I wouldn't say that this is like forever dead money or so damaged that it can't recover. I'm just saying I don't remember the sentiment being this negative around the stock for the last couple of years. It's pretty black right now.
It had a really rough 2022, and it had a good 2023. No,
Mike, it's in a 50% drawdown. What are you talking about?
I'm talking about this.
How many large cap tech stocks can you think of that are in a 50% drawdown with the stock market at an all-time record high?
I know that this is start and end date dependent because it had such a bad 2022. Do you know what Tesla stock did in 2023?
I bet you it did not outperform the NASDAQ.
You are dead wrong.
What did it do?
Tesla stock.
How much was it up in cap?
Dude, Tesla stock was up 100% in 2023.
Really?
Yes.
Oh, I wouldn't have guessed that. So how much? So it must be down a lot year to date.
It's having a rough year. Yeah, year to date it's down 23%. And the thing is,
what's this about options activity?
Hold on, I'll get to that in a second. But again, just talking about expectations and pulling forward the growth, it was up 10x in 2020. And it's working off all of that froth.
Understood, and that's not easy to do.
Yeah.
But it is not the only company that went up that much and is still building on those gains. I don't want to have to use the N-word on a live broadcast, but I mean, there are more NVIDIA. Relax. There are more companies that are large cap tech that had huge years and or continue to build on them. This one's not. That's all I'm pointing
Tesla
out.
is
Which one of these things is not like the other?
True. It's such a polarizing stock. It's unbelievable. It made up 11% of all activity in the U.S. options market. Was that last week? More options traded for Tesla than for the Qs, which is really inexplicable.
That's wild. So there's more options activity in this one stock than for the whole index ETF. I wonder if that's true for like all other stocks that are in the Qs. You think any of them trade as much options as Tesla? Probably not.
No
way, right?
No way.
Yeah. Okay. Is that all we have to say on this? We'll say more on Monday.
We'll say more on Monday.
Okay, fair enough. Are we gonna do this Dan Ives stuff, or we'll do this another time?
Save it.
We'll skip it. All right. I think that this is the part of the show where I pitch you stocks. I think that if the AI opportunity is going to be as big as everyone seems to think it will, we're really talking about something much more substantial than GPUs. We're talking about a top-to-bottom remaking of corporate America, because everyone is going to want to capture the opportunity and utilize AI to build profitability, build companies, innovate, et cetera, et cetera. I want to share something that this is just like one example, so it's not like the main point here. Can we put this picture up? Blackstone is building this. This is a Bloomberg article. Blackstone is building It is indeed. That is a Bed Bath and Beyond. Blackstone is building a $25 billion empire of power-hungry data centers. The private equity giant says landlord QTS could be one of its best investments ever, but the resources needed for growth. Okay, this is in Phoenix. It's 60. The land itself is 60 football fields. That building that you're seeing is one of 5 what they're calling bunkers. 30 miles away, there's another complex going up on 400 acres, which is 3 times the size of the Mall of America's footprint. Like, this is how Blackstone, private equity firm, the huge real estate involvement, this is how they're playing the AI revolution. Like, Blackstone is not making microchips. So they bought this data center called QTS in 2021. They paid $10 billion for it. They are the largest private equity firm in the world, and they're utilizing this QTS to build out the infrastructure that's going to be required for all of this AI and just this next generation. And then there's a lot in the article about the power needs, which we're not going to get into right now. That's another opportunity. But what I want to just make the point is that you can't just be like, all right, let's all do generative AI, and then like it just happens. The amount of infrastructure that's going to be necessary in order for everyone to be able to access these tools and utilize them 24 hours a day all over the world is in itself a huge opportunity, like an absolutely huge opportunity. So I want to talk about a research report that Dan Dolev and Sean Kennedy put out at Mizuho, because they put out some names that are pretty under the radar. They're in an area of the market that not a lot of people pay much attention to, that I think could get very red hot as we all look for new ways to play AI. So let me just quote from the report. Basically, they're looking at IT services, which is, there's about 6 or 7 stocks in the sector. They call this the picks and shovels of AI. Dan and Sean say IT services, a $1.3 trillion market, which is 30% of IT spend, has increasingly outpaced global GDP growth, should accelerate to a 9% through 2027 versus 7 to 8% over the last 5 years. AI is having its iPhone moment. We expect will drive a $450 billion AI services sales opportunity. The best way to think about IT, Michael, these are like us. These are financial advisors, but to the CTO of Fortune 500 companies. So when Pepsi says, yeah, we're going to do AI, they have to hire somebody to implement it. Like, Pepsi can't just like start building AI tools for its business. These are the companies that get hired. They analyze the marketplace. They determine the best way to build, what you want to build, who to hire, what equipment you need, where you want to put your infrastructure, who you need to hire, who you need to sign contracts with. They're like basically giving advice. So it's a very CapEx light business model. And when they hit one of these cycles, the earnings expand like crazy. Profits expand like crazy because the phones are ringing off the hook. So I want to show you a couple of these stocks really quickly. The first is Accenture. Dan and Sean have a buy $426 target. It's a $373 stock right now. We expect a recovery in IT spending over the next 2 years to drive growth acceleration. Accenture's significant exposure to fast-growing markets like cloud, which is 50% of revenue, should result in growth outperformance. Next one is the Glob. This one I do know, Globant. By the way, these are tiny stocks.
Accenture's not a tiny stock. Accenture's not a tiny stock.
Accenture's the biggest one. This one's like $11 billion, I think. GLOB. The company is based in Luxembourg, was started in South America, but it's New York Stock Exchange. GLOB is a $240 stock. Their target is $283. Same story here. These are going to be the picks and shovels for AI. Nobody can do this without help. These are the companies that are going to get hired. One more, EPAM, EPAM. That is both the company's name and the ticker symbol. You can see that this thing got killed in 2021 and 2022. But this is another way to play corporations that are going to need AI-related advice. And I just want to, what did I want to say on that one? Nothing in particular. Look, I think when you look at some of the biggest winners that, and we've talked about them on the show, Supermicro Computer, which I think went up like $300 a share. I know you don't like dollars, but it's important. It went up like $300 a share. I don't know if you've looked at it lately. When you think about Arista Networks, what those two companies have in common is NVIDIA is not going anywhere if those companies aren't in the mix, because you have to build out the accoutrement of AI. You can't just stick a GPU in the ground and hope an AI service grows, to show for that. So this is another area. I think that the amount of IT spending that Sean and Dan are talking about, like I wouldn't know if they're going to be right, but directionally it feels like it's going to be right. These companies are going to have their work cut out for them for the next 5 to 7 years, and I think should be pretty reliable earnings growth stories. So just a couple of more names on your radar. What's also interesting, last thing, especially EPAM and Globant, because they're so small, they offer small and mid-cap managers a way to get exposure to AI. They can't buy NVIDIA. If you're a mid-cap manager, you know your investors are calling every month, like, how are we playing AI? These are the types of companies that fit. You can no longer buy AMD and NVIDIA. They're not in your universe. So they're fairly unique. There's not a lot of pure plays on IT spending in the small and mid-cap indices that are going to have that much involvement in the trend. So I don't own any of these stocks. That might change. Just something I wanted to put on everyone's radar. And shout out to Dan Dolev and Sean Kennedy for sharing that research.
Accenture looks amazing.
Doesn't that stock look so good right now?
Yeah, it's been overbought a lot, which is a good thing. It's a good thing. An overwhelming amount of demand for the stock is a good thing. I wouldn't buy right this second. It's just, it's so extended. But on any point,
put up the Globant chart again. This looks like you can see the downtrend has been snapped, but it's not carried away yet, and this looks like a breakout.
Yeah,
like
looks good too.
I don't know what that December high is right at the end of the year, but it looks like we're gonna challenge that.
Yeah, it looks good.
So we're gonna keep an eye on these, and we'll keep you guys updated on them for sure.
I feel like JC would love this chart. Got super overbought at the end of December, and then worked its overbought condition off over time. Very, very healthy. Apple, Duncan shared this with us before the show started. Apple Podcast for Creators. Coming this spring, transcripts will make your show even more accessible. Your audience can search within the episode. I mean, this is really awesome. Chart off, please. I was talking with Ben on Animal Spirits after I made my 2024 prediction list about Apple having a rough year. Somebody emailed us and was like, if you're sleeping on Apple and you don't think that they're going to be involved in the AI game, you've got something else coming. Yeah, they're not making splashes. Tim Cook won't even talk about it on earnings calls, but they're definitely not asleep at the wheel. My friend showed me this the other day. You could search on your iPhone. We were talking about one of the burger spots that we had in the city. You could search cheeseburger in your pictures, and it will show you all of the pictures of cheeseburgers that you've ever taken.
Did you go to Gotham yet?
Uh-uh.
You didn't take Ben there last night? Where'd you
No.
go for burgers last night?
No, we went to Bar Pretty. Pretty? The pasta place that we went to after the Irishman?
Yeah. Bar Pity.
Bar Pity.
I'm dying to go to the Gotham Burger Social Club. I think I know the guy used to DM me back in the day.
Gotham Burger.
Not you and I. So
there?
I think it's the same guy. It was him and a group of friends, and they were Wall Street guys. And every week they would meet somewhere for a different burger. And then he started making Oklahoma smash burgers. Do you know what Oklahoma burger is? You know what that
I
is?
have never been here. Oh, we were just talking about going here,
No,
weren't
it
we?
just opened last week. Of course, you've never been there.
Yeah. Well, I'm confirming. See, I'm confirming. I've never been there.
Do you know what that is? Like an Oklahoma style smash burger?
Stop asking me. Just tell me what it is.
No, I'm asking you. I'd never heard of this. I didn't even know this was even a thing. It's like
with the onions?
they shave the onions and then they like White Castle, but
This
like
is
it
all I
has a name
see on
apparently.
Instagram these days. This is all I see.
Yes.
We gotta
go. We have to go. So I
Holy
think I know
shit,
this
that
guy.
looks
I
good.
think he used to DM me and invite me like 7 years ago, and now I guess he started his own actual burger place.
We're very far off the topic, but this is hilarious. So Eater, like this food magazine, whatever, covering, says the burger is made by pulverizing one or more beef patties at a flat top grill. What a great description. Pulverizing.
I'm in.
I would pulverize this burger. Let's do it.
I would pulverize this burger tonight. All
All
right.
right. Anyway,
you.
we were talking about Apple and the AI. They're building shit. Nothing to save the Vision Pro, but they're building.
Okay, that's super insightful. You're up.
We were
next.
talking about all these spend on AI, asshole. Were you not here 5 minutes ago?
So Apple's building shit.
They're building.
Okay, I'm ready for
All
it.
right, get back to the office. Remote work. Wait, put that chart back. Put that back on. Remote workers.
Just because you're wearing a sports jacket doesn't mean you can start yelling at me, sir.
Get back to the office. You're fired.
That's not how it works.
Remote workers bear the brunt when layoffs hit. So, all right, workers logging on from home 5 days a week. 5 days a week. What is this? 2020. We're 35% more likely to be laid off in 2023. That's a big number.
The way you're dressed today, you look like you laid off 15 people.
Dude, get back or you're fired. So this is obvious. Like, and we're going to talk about layoffs in a second. When a hiring manager, here's a quote, when a hiring manager gets news that they have to cut 10% of the staff, it's easier to put someone on the list you don't have a close personal relationship with. Duh. No shit.
Wait, I don't understand. Hold on. So you have to lay somebody off that you've never met before. That happens
It's
all the time.
lot. If you're told, hey, we're doing layoffs,
Yeah.
it's way easier to lay off somebody that you never see.
Agree.
Duh.
There was a movie about that with George Clooney.
Up in the
and
Air.
Anna Kendrick.
Up in the air. Great
Is that
movie.
her name? Anna?
Yes.
Wasn't that great? And who else was in that? Who was
What's
the
her
female
name?
lead? Was it
Via?
Vera Farmiga?
Vera. I don't know. I'm turning with my dad. I just keep getting,
The Conjuring woman.
and
Vera.
and the Departed.
Right. So he just like gets on an airplane, shows up somewhere, and lays off 600 people, and then gets back on a plane and goes and does it somewhere else.
Great.
And it's like a job.
Remote workers are also more likely to quit. So 12%
Yeah,
of
well.
fully remote workers left their company and began a new job within 2 months. So yeah, it's enough. It's not 5 days a week anymore working from home.
Listen, we have fought this battle along with every other company. The upside to this world that we live in now is that you can find talent anywhere. You can hire people and employ people who have a less demanding cost of living in different parts of the country. You have a lot of flexibility. The downside is exactly what you're pointing out, Michael. You have people that are really less connected. I don't care how many Slack channel shit you send to them. It's really, really hard. And I don't think we're going back to 100% office attendance. I don't think anyone thinks that anymore.
Nope.
So now the question is like, what are the best practices to do hybrid, to have people in person, have them remote, travel, see people where they live, bring them to where you work. It's the puzzle, and people will get really good at it. I hope we're getting better at it.
Not to brag, but I feel like we've gotten really good at it.
Yeah,
no?
But not perfect.
Next chart. Office. This is from Torsten Slock. Office occupancy rates moving sideways, and this is
it's not changing anymore. It's just like this is the new status quo. You're saying
this is it. This.
Look at this shit.
I think it's permanent.
What is the index? The percentages? 50%.
Yeah. It's office occupancy rate.
Wait, what's the highest? What's the orange? Oh, Austin. That makes sense. Okay. The age of the workforce, I think, plays a really big role in this, and not in the way that a lot of people might think.
You think young people are more likely to be in the office?
Yeah, they want to be, and you can control them. You can make them. Like, young people have overall, if they're making a good wage, first of all, they don't want to sit in their house. Who the hell wants to do that at 22 years old? You don't have a baby that you're taking care of. What the hell are you doing at home? But also, they kind of need to move up in a company. They need to show their face.
You can't get a promotion.
They're not good.
You can't get
Right.
People get promoted if their bosses like them. And
yes.
You can only like somebody so much on Zoom.
That's right. 100%. So that's why a city like Austin has a higher occupancy rate than, let me see who I can make fun of. Who else is on here? What do you think is the bottom? I can't say. It's something dark blue. Los Angeles would make sense.
San Jose? Or Dallas?
San Jose actually makes sense because it's all computer shit.
Yeah.
Okay. Can we talk about stock market concentration?
Oh, a new topic.
Well, I think Vanguard, because they are the index champions. So whenever the conversation turns to concentration, you'll hear people blaming indexing for it, which you and I have debunked, I don't know, 9 million times. But I thought this was an interesting chart. They're showing the number of companies that explain fractions of market returns. So this is quoting, since 1926, out of thousands of stocks, only a mere 72 stocks accounted for half of the market's total return. The trend holds true even when excluding recent mega cap tech boom. Year in and year out, a select few stocks have played a significant role in driving overall return. So here's what's interesting about this. The active people will tell you this is why you have to pick stocks, because only a few of them are really going to go up and be like the source of returns. The passive people will say the same thing. They say this is why you have to index, because if you miss those stocks, you have no returns to show for it.
Yeah, guess what? I think both are fair.
I think both are reasonably fair points. Next chart.
Wait, can I say one thing? Hold on, just on this topic.
You are wearing a sports jacket, so by all means.
I don't love this study. Hendrik Bessenbinder did great work from the University of Arizona. That 4% of all listed stocks are responsible for 100% of the wealth creation in the stock market. And while that may be true in the sense that most stocks that come to market are not worth buying at the IPO and holding forever, right? That's just a fact. We know that. Most of these stocks, if you buy them, you hold them forever, a lot of them underperform cash. But it makes a giant assumption that you buy in the IPO and you hold it forever, and that there's no opportunities in between, which is kind of nonsensical. It's not the real world.
I'm really glad you said that. Just one really obvious case in point is Meta. This is a stock that came public at 42 and within a few months tumbled to 18 or 12, I forget. And then, of course, I don't know, before the split, 500. So did you buy it on the IPO? All right, not a great outcome for the first year, but you still did well. Did you buy it 3 months after the IPO, cut in half? You did even better. So there's a lot of return there. It just doesn't show up in the study that starts from inception or IPO.
Exactly. Like one of Duncan's favorites, not to pick on Duncan, Oatly, has been a really bad stock to buy and to hold. But guess what? If you bought Oatly 3 months ago, you're up 155%.
Oh, really?
Yeah.
Did Duncan make money on that yet?
Well, now he's only down 98%.
Okay. All right. Next chart. Difference in return if underweight the Magnificent 8 versus the S&P 500. So, man.
Wait, what is this? Difference in return. Got it. Yeah, you're screwed.
If you're underweight the Magnificent Eight, you cannot have feasibly performed versus the S&P 500. That's the takeaway.
Yeah, this chart makes me very empathetic towards active managers. It almost seems not fair.
Let me read the numbers for those listening. If you were 10% relative underweight the Magnificent Eight stocks, when does this start? Do we think?
That's weird.
Oh, this is just 2023.
So like if these stocks were 30% of the index and you only own 27% of them.
Right. So if you were 10% underweight last year, you were minus 5.4% versus the S&P. If you were 25% underweight, you were minus 13.6. And if you were 50% underweight, which most value managers probably were, and then some, you were negative 27.8%. Versus the S&P 500.
Really
if
tough.
You're an active manager, you better have had a great year in 2022.
Yeah.
If you were negative 27 versus the S&P in 2023. Because I don't know how you explain it otherwise.
Here's another thing that active managers can say, 2023 notwithstanding, because that was just an absurd year. Shouldn't expect that. Absurd. Is that exactly a lot of stocks aren't worth owning. And if you avoid the losers and just avoid, and not just, it's difficult, but that you could make that case too. And I see that side of it as well.
Fair. John Butters at FactSet did something great at the end of last week. I mentioned this on TV today because I think it's important. He asked the question, are the Magnificent Seven the top contributors to earnings for the S&P 500 for Q4? And then he answers. The answer is, of course, yes, but I don't think people understand the degree to which these companies matter. So I opened the show tonight saying, this is the only week that matters. It really and truly is this time. Not always. 6 of the 7 companies in the Mag 7 are projected to be the top 6 positive contributors to year-over-year earnings for the S&P 500 in Q4. So the earnings season that we're in right now. NVIDIA, Amazon, Meta, Alphabet, Microsoft, and Apple. So leaving out Tesla. In the aggregate, these 6 stocks will report year-over-year earnings growth of 53.7% for Q4. If you exclude those 6, the blended earnings decline, which takes actual earnings and estimates, would be negative 10.5% for the S&P 500.
Ew.
How insane is that?
Wow.
If you pull those 6 stocks out, the S&P is a year-over-year decline of over 10% on earnings. One more thing.
So it's not the index pushing those stocks higher, it's the earnings.
It's the earnings. Quote, this is Butters, and I'm going to show you some charts. In aggregate, these 4 companies are projected to report year-over-year earnings growth of 79.7% for Q1 of this year. Excluding Meta, Amazon, NVIDIA, and Alphabet, the remaining 496 S&P companies would be projected to report year-over-year growth of 0.3%. That's for the quarter we're in right now. So it's just remarkable how important these companies are, not just for Q4 numbers, but even going forward. For this quarter, they are all of the growth. Wow. Let's do some charts. So this is showing the 53.7% earnings growth that you're getting out of the top 6 versus the minus 10.5% earnings growth you're getting from the other 494 for the current quarterly earnings that we're getting. This is, Mike, this is fucking nuts. Next chart. This is showing the big 6, their contribution to earnings growth year over year. The big one is Meta. The second biggest one is NVIDIA. And then Amazon and Alphabet bringing up the rear. Last chart. This is Q1 2024. So again, Amazon, Google, Meta, NVIDIA, 79.7% earnings growth expected for the quarter that we're in. The other 496 companies, 0.3% earnings growth.
I don't get it.
What don't you get?
These 4 stocks are expected to grow their earnings by 80% year over year.
This is the contribution to the overall S&P's earnings growth. Yeah, it is.
No.
What do you mean no?
Chart back
It's
on.
not the contribution to the earnings number. It's the contribution to the growth.
No, it's not. Because those two numbers should be 100% if that were the case.
In aggregate.
It says
Here, read
earnings
it.
growth year over year.
In aggregate, these four companies are projected to report year-over-year earnings growth of 79.7%. Oh yeah, that's the earnings growth number.
Maybe that's all NVIDIA. I don't know. That just sounds really odd. That sounds.
Did Meta take a huge charge in Q1
yeah,
of
there's gotta be
23?
There has to be some.
There's
funky
probably some
stuff
shit
in
like that. But still.
Either way, it's crazy.
Yeah. All right. Go ahead.
All right. We're sorry. Okay. We're rallying. We're doing it. All right. I mentioned earlier, like the setup for Q1 or Q4 earnings and why we should expect, why we should be surprised that the beats aren't rallying. So Carl Quintanilla tweeted, this is from the Goldman Sachs desk. This has been one of the most powerful short cycle rallies we've ever seen. The 19% rip in the S&P 500 over the past 3 months registers in the 99th percentile of market history.
I didn't know that.
This type of move usually happens coming out of recessions. Really interesting.
That's from Pasquarello at Goldman Sachs. I didn't know. I didn't know it was that big of a rip. So what is that? October, November, December of last year, or
Wild.
that's using January? That must be.
That's January too.
Chart. That's
It's
January.
January too.
Okay, so it's. Okay,
But it's just
so it's
interesting that those rallies have tended to happen coming out of recessions.
We had a sentiment recession. We had a sentiment recession. Does that count?
We did. Dietrich said something similar. He found a 19% gain in 3 months, 17 times. 17 times where this happened. It was higher a year later, 16 times. And not only was it higher, it was higher by 34% on average. So again, this usually happens coming out of a recession.
Hold on. So Dietrich is saying that out of the 17 times this has happened, meaning a 19% gain in 3 months, 16 of those 17 times the market was higher a year later. That's
16 of 17.
That's amazing. Think about that.
Well, it's not amazing if you understand that most of the time this happened was coming out of a recession, i.e.,
That's
not
less
i.e.,
amazing.
e.g., no. I don't know what two less I'm looking for.
E.g.
Out of a bear market.
Yeah, but also being up 34% on average a year later is
That's wild.
Wild. Even coming out of a recession.
Coming out of bear
Still,
markets. All right, so I wanted to just shoehorn this in here. So Buchel Capital guy Capital guy tweeted.
By the way, people always I see his tweets make it to Instagram, which means they're really funny. Who is this guy?
No, he's not just funny. He's also like not an anonymous dick guy who just posts like nasty shit. Like he's clever and funny and smart.
Do you know him?
I don't.
Okay.
He tweeted, businesses realize they're not going to get margin increases by raising prices anymore. So how are they going to protect or raise their margins in 2024? The good old fashioned way, firing people. That was Jason Cummins on Onlots.
Yeah, good call.
So
seeing it everywhere.
Today we saw PayPal plans to reduce its workforce by approximately 9%, impacting roughly 2,500 employees. Obviously, really awful for everybody impacted. Good for the stock price.
UPS announced 12,000 layoffs today.
UPS today, 12,000 layoffs. They see $1 billion in cost reduction. The Block.
Amazon has had some pretty big layoff news lately.
Dorsey's Block lays off close to 1,000 staffers. So here's what PayPal said, and Josh and I both own that garbage stock. They said, we need to drive more focus and efficiency, deploy automation, and consolidate our technology to reduce complexity and duplication. We are doing this to right-size our business, allowing us to move with the speed needed to deliver for our customers and drive profitable growth. So you could see a year like this, and this could, again, awful for real people, good for the stock market.
I have a stop loss in on PayPal, but it's like poker. I don't want to tell the street where it is.
Don't do it.
You never say where your stop is.
But
right?
Anyway, I just thought that quote from Jason Cummins.
Yeah.
That quote from Jason Cummins, we're seeing it.
Yeah, 100%. You see,
remember
the thing is, it's name brand companies doing these layoffs. So you assume that they're emblematic of what like everyone's doing, but these layoffs never in the aggregate affect the unemployment number. Now, maybe the January number, which we'll get the first Friday of February, is that this Friday? I think it is. Right? This Friday is the 2nd? Okay. So you're going to get January unemployment at the end of this week. Maybe this will be the month where those like corporate layoffs, UPS, 12,000, maybe this will be the month where they actually hit. But like so far, we've had like 18 months of layoff announcements and they're not really changing much. Wages stopped going up. That we know. Quit rates have come down. That we know. But we haven't had like a downside surprise in employment.
I feel like the layoffs
upside surprise in unemployment.
They're overrepresented in our brain because they're from massive names, right? Like we saw Google do around.
Yeah, that's my point.
Just think like, yeah. So, all right, I'm going to make the case for China. And this is very simple. I bought
Fade.
FXI. What?
I'm just kidding. Just kidding.
What did you say?
I was fading you before you even said a word.
I bought.
Go ahead. I'm listening.
I bought FXI last week. Full disclosure. So okay, China, not surprisingly, relative to the S&P 500, at least through this vehicle, is trading at an all-time low since it began trading in 2005, I believe. We know it's bad. There might be a double bottom forming in the price. Next chart. We'll see. Last time I was here, it had a furious rally from 20 up to 33. Again, we'll see. I don't know if this is max pessimism because that's to say that it can't get worse, and of course it can. But nobody, people are bailing like you wouldn't believe on China. The forward PE is basically as low as it's ever been. It's at 8 times forward earnings. Steve Schwartzman recently said China is trying to re-engage with the West to reverse a slowdown. Yeah, not a shock there. Quote, the Chinese have decided that they really need to re-engage. Right now, they have a negative foreign direct investment. This is a terrible situation for them. They want to reverse it. And last week you saw an actual explosive frenzy of buying activity for the first time. You haven't seen something like this in 8 years. And lastly, I think it would be really poetic if the bottom of China coincides with Jeffrey Kleintop's tweet saying that there will not be a bailout of China Evergrande Group, which received a liquidation order from a Hong Kong court today, beginning a long process to carve up the biggest casualty of China's property crisis. I can't imagine the news flow getting worse. Actually, that's not true. I can't imagine it. I would think that given how bad everything is, given how loud the headlines are, how bad the performance is, there are no bad assets, only bad prices. Of course, that's not true. There are bad assets. But you see what I'm saying? To me, this is just a very obvious sentiment washout. That's all.
So with international stocks, there are bad assets because there are governments that confiscate them, and then you never know if you bought it at a good price or not. I don't think that's going to be the case here. I'm just making the point. We have seen that. Like Russian stocks were trading at 1 times earnings at one point, and then there was a reason why, and the market was right all that time. I think if you're a true contrarian, you're just buying the K-Web right now, eyes closed, not even reading the news, because I have never, ever seen anything like this. You're talking about basically these stocks are now flat since inception of the ETF, and these are not bullshit companies. These are some of the biggest companies on earth. It's Baba, it's JD, it's Trip, it's like Tencent, huge entities with millions collectively, millions and millions and millions of employees, billions of customers, dare I say, and just massive revenue, cash flow. But they're being treated as though they're uninvestable by actual buying and selling in the marketplace. And that has been going on for a while, but it seems to have been accelerating. The problem recently, that big spike that you referenced in money coming into China, it wasn't random. It was ahead of the RRR decision. So there was this idea that the reserve requirement would be lowered, which is their version of interest rate cuts, substantially to support, quote, support the stock market. And China didn't do it. And I saw somebody on Squawk this morning who seems to know what he's talking about. He's been following China for decades. And he said this idea that they're like seeking to look like America and they're going to juice the stock market and they're trying to build a middle-class consumer and all. It's just not true. They're not pursuing this growth model anymore. They're not obsessing over GDP anymore. They're trying to just keep control of the economy, and all of the fairy tales that we've told ourselves that they would one day grow up to look more like us have now at this point been completely extinguished. Like, the Chinese tech stocks are not going to look like Apple, Google, Microsoft. It's just not where they're going with this. So maybe the things that I'm saying are the things that are out there in the ether and are necessary to put a bottom in. It's definitely possible. So if you're a contrarian investor, take all the words that just came out of my mouth and bet against them. And maybe there's a 20% rip here because Biden and Xi have a conciliatory phone call or something. But I agree with you. Like, this is as bad as I've seen sentiment toward China since I've been in the business. I mean, it's really.
I just feel like
nobody
the
can
risks
say
are
anything positive.
I think. Listen, I don't. Obviously, I'm not even a Taurus. I don't know shit about this, but I just feel like the risks are asymmetric. Yeah, could you have 20% more downside? Sure, why not? But man,
the property sector, just so you understand, the property sector in China is so big. It's like 25% of the economy is fed by, and just for the viewers, when we say property sector, in China, you do not own property. You don't own the land your house is on. Nobody does. The state owns the land. It's 100-year leases, okay? So let's start with that. Imagine, like in New York City, if America owned all of Manhattan Island and they leased the land to Stephen Ross or whatever to build Hudson Yards. That's China's property sector. It's big business. But it's a very, very weird animal, and it's honestly having like a very tough time.
Josh, is this not how markets bottom? Like, there's no bailout.
No, I agree.
There's no bailout. Like, that's it. That's as black as it gets.
Yeah, they got taught a lesson, and I don't know the mind of the Chinese financial authorities, but I think they wanted to teach everybody else a lesson. Don't be like Evergrande, because we're not going to save you. Like, I think that was important for them. So maybe, was that the Lehman moment for the Chinese property market? I'll leave that to a China expert to decide. I'm just looking at price action and relative valuation. I cannot believe the levels that people are willing to sell these stocks at. To me, it's incredible. So I love that you brought this as make the case, and we'll follow the story. I have a mystery chart. We'll do it real quick, and then we'll get out of here. John, if you please.
What in the? Got it.
This is today. We talked about the stock, and they reported after the close. Guess what it is?
I mean, this is what I see. I actually.
It's not that hard. It's not that hard. We talked about it today, and they reported earnings after the close. Not that hard.
You expect me to
just take a guess? What's wrong
AMD.
with you? Oh my God, was that so hard? Look at this. You're smarter than you thought. I think it's the jacket. Can we get a longer term view on AMD real quick for Michael? So this is what I was saying before. You got a stock that goes from, this is from November, homeboy. You got a stock that goes from $90 on Thanksgiving to $180. It almost doesn't matter what they report. Like, nobody should be surprised that there's a little bit of a pullback here. So that's what I was trying to say. Chart off. But I am happy you told me to sell it, and I did listen. So
there we go.
Should we end it there?
Hey,
everybody.
Hey, everybody.
Tomorrow is Wednesday, which means when you wake up, brand new episode of Animal Spirits. And Michael, it's a special episode, I'm told.
Can I tell you something? Why? Because we were in person?
No, you and Ben were at the New York Stock Exchange.
Oh, no. That's a different thing. Ben and I recorded in person, and he opened the show with a pretty strong bit.
A pretty strong take?
No, a bit. It was a bit. It made me laugh.
He did a bit? He's doing shtick, Ben?
He did a shtick. It was good. I was laughing.
Maybe the comedy club rubbed off on him? I can't wait.
No, this is before the comedy club. It was very funny. Credit to Ben.
All right. Shout out to Ben Carlson. My favorite podcast in the world. Coming out tomorrow morning. Michael and Ben live in person together for the recording. That should be cool. Ben's going to do an all-new Ask the Compound on Thursday. And then we have the Compound and Friends at the end of the week. So
and
it's a full
great quarter
week.
guys and great quarter
And great
guys on
quarter
Monday.
guys. We're
giving
doing
it.
that Monday.
We're just vomiting content. Bad choice of
flames.
words. So much.
All right, guys. Thanks so much for listening. Everybody have a great night.